Greetings and welcome to the channel. I would like to talk about how I accidentally, coincidentally, intentionally ended up in a situation where I was able to retire early. I'm not sure what the best descriptor is, but looking back at what I did over my life, I'm not surprised it happened. But what did I do, and what are the things that might lead to an early retirement? These are things that worked for me. I want to discuss the choices I made. Not all of them were good, but these are the things that I did on my path to early retirement at the age of 48. Again, not sure if it was an accident or coincidence or it was intentional, but I was originally not planning on retiring that early. I was thinking 55 would be the earliest I might retire. And that was probably 10, 20 years ago that I started thinking that that might be an option. I'll start in the mid-1990s when I was in my early 20s. I was at my first duty station, had a car payment, and probably not more than $1,000 in savings at any given time. I saw a retirement compound interest chart similar to this one, which showed me I could be a millionaire by 65 if I just saved $166 per month, which, if you remember, that was the old IRA limit of $2,000 a year, $166.66 a month. I remember physically going to a Fidelity office in Portland, Maine. I'm not sure if this is the exact same place. If it hasn't moved in the last almost 30 years, then this is the building I went to. I don't specifically remember it. I only went there one time. But I opened a traditional IRA for $500. On a side note, that $500 is now worth over $5,000, accounting for how that account has done and the differences in investments that I've made over the years. It's only been a couple different ones. In 1998, I switched to a Roth IRA, which that was the first year that they unlocked the Roth IRA, and contributed the limit for years in an equity income fund. After about 10 years of a pretty flat market, it hadn't gone up much, but I continued to buy in at a fairly low price, which has worked out great over the years. But for that first 10 years, it really didn't do much of anything. Especially, well, if you remember 2008, that's a good reason why it didn't end up doing a whole lot. I actually stopped contributing in 2011, but the growth has been pretty ridiculous. Most is currently in an S&P 500 ETF. So I've switched most of the value of that retirement account into an S&P ETF. The next contributing factor was my health and the health of my family. Had a lot to do with my ability to retire early because I didn't have any chronic conditions or physical impairments that prevented me from military service, and therefore the benefits. Those benefits are probably, well, they are definitely the number one reason I've been able to retire early. Continuing to exercise and annual physical exams have prevented possible setbacks after my military career. It's also been helpful that my sons and wife have mostly been healthy. I can't imagine how horrible it must be for those with sick children, both mentally and financially. We can do things to improve our health, but there are so many things that can go wrong no matter what we do. The next thing is kind of related. If you can avoid financial health catastrophes, dealing with debt is something you can have much more control over. At the beginning of my financial journey, I purchased Personal Finance for Dummies. Eric Tyson really emphasized paying cash, especially when it comes to depreciating assets. Over the last 27 years, I've probably had a car payment for about 3 years total. Most of that was early on, and what made it fairly easy for me was that I saw a car as only transportation. So I've never wanted, fortunately, or purchased a very expensive vehicle. Tried to get reliable vehicles, but for me, it's just a way to get A to B. We currently have a 10-year-old Toyota Corolla with 70,000 miles on it, and I'm planning on driving that for at least another 5 to 10 years. I also refuse to pay interest on any purchases, like on a credit card purchase. I don't recommend it because of the danger, but I use credit cards and pay them off every month while accumulating rewards. The two major problems I see with credit cards are, first, the temptation to just make the minimum payment. When you see that minimum payment come in, say your balance is $3,000, but your minimum payment's say $50, it could be pretty tempting to only make that $50 payment because that's all you really need to make. They've made requirements to where they show you, if you make the minimum payment, how long will it take to pay off the card? You look at that and it's maybe 17 years or whatever the number might be for you. Think about it and think about how much interest you're paying on your whatever you're purchasing on it. So if you're buying a coffee maker for $70 and over the course of 15 years you pay $220 for that coffee maker, does that really seem like a good deal? And number two, the likelihood of spending more than you would if you're just using cash. This was something that I remember specifically from Personal Finance for Dummies, that people in general are more likely to spend less if they're only using cash. One, it's more limited, and two, it's a physical item that you're giving away. So you're less likely to spend as much. You're more likely to, say, if you're going even just at the grocery store, you might make a couple fewer purchases because you're thinking, well, I can save a couple dollars. I don't really need that. I might be able to save the money. That didn't work for me. I'm already like that even when I'm putting things on the credit card. I'm like, well, I don't really need that. I'm not going to get it. So I'm not much of an impulse buyer anyway. So for me, it has worked over the years. I'm not saying that I've definitely spent less because I've used a credit card. I've probably spent a little bit more because of it. But I know for me, it hasn't been much, maybe a few percent, which is a big thing over a 30-year period. But I feel like it's been offset by the rewards a little bit because of how little I think that I actually do spend extra because I have the credit card. I was forced to borrow money when I bought my first house, as most all of us are. When I was transferring back to the States in 2002, I knew I wanted to buy at that time. That was going to be the first house we ever bought. And obviously I was going to need a mortgage. Now, again, going back to Personal Finance for Dummies, I did want to put a 20% down payment just to make sure I had equity in the house, to one, also lower the payments a little, avoid the PMI, private mortgage insurance. And it seemed like solid advice, so that's why I did it. It's hard for me not to call this luck because of the time I bought it, because 2002 to 2005, the property values in Virginia Beach, along with most of the country, skyrocketed. I didn't sell in 2005. I ended up transferring in 2008, which the prices had come back down a little bit. Actually a fair amount from the peak. If I'd have sold in 2005, would have been the most I could have possibly made off the house. But in 2008, it was still up significantly from where I bought it. And I went ahead and took that money because I was transferring to a location where I knew I wasn't going to be staying. I was going to be stationed there for 3 years, and then I was going to move again. And I had no interest in buying in this location. So I saved the money, put it into a high yield savings account. I wasn't going to try to invest it anywhere. I just put it in a savings account. And I think it was actually a certificate of deposit I put it in, a very large certificate of deposit I put it in. For me, it was very large. And saved it for when I retired from the military and transferred out in 2012. We purchased what we hoped would be our forever home, this time with a down payment of around 60%. At this point, I figured I would probably retire around 55, and not having a mortgage would probably be nice. Not to mention I hated that over half my mortgage payment was interest. When I started and I saw that, I mean, I already knew that the interest was a much higher percentage of the payment than the principal. But it really bothers me when I'm paying a whole bunch of interest, which is really not getting me anything. It's the opposite of investing for me. And it's something that you have to do with certain things. If you're going to buy, for example, a house or get an education, a lot of times you have to spend more than the actual cost. In 2020, I paid off the mortgage, even though the interest rate was very reasonable. The value of that house had also increased quite a bit, and we were able to sell it and purchase our current home in cash in 2023. Not having a mortgage or rent is a huge net positive when it comes to monthly cash flow, and it was a big part of how I was going to be able to retire early, considering a lot of my retirement is based on my military pension. And so the lower my monthly payments could be, or in the case of a mortgage, not having it, considering that's one of the largest expenses most people have, if I didn't have that expense, that means my pension goes a lot further. Additionally, with housing, I only bought when I was relatively certain that I was going to be in a location for more than 7 years. My first transfer was back to the Norfolk, Virginia Beach area, which I knew I could probably transfer. I was originally planning on transferring and staying there for my final 3 tours in the Navy. Didn't work out that way. I ended up going to one other location. That's why I ended up selling in 2008. But it worked out. I'm not saying this would always work out. I did get lucky in a sense that when I sold, the markets were up. When I bought, they weren't necessarily down. The first time was down. Second time, the market was kind of flat in 2012 where I moved to. Hadn't really been doing anything up or down. And it didn't do much up or down for the first 6 or 7 years that I lived there. The value of my house really didn't change. It had gone down a little, up a little. It fluctuated around the same price as I bought it. Finally, in the last few years, it did go up. But again, that's just luck. There was no timing. I wasn't planning on this happening. But the purchase of a home is normally a sound decision. Something that wasn't a sound decision, but still a positive in some ways. I did learn some things. The home purchases worked out, but I did make some investing mistakes early on. If you're old enough, you'll remember the dot-com bubble. In 2002, I was being safe by buying a tech mutual fund based on past performance. And if you know anything about any prospectus, it'll say past performance is no guarantee of future results. I had read that, but I didn't think anything of it when I thought I'm missing out. So I had a lot of FOMO over this stuff. And I just, at that point, had money to invest. I was just now getting ahead in my career, and I had money that I could put into the market, and I was going to make money off of this tech fund that I purchased in my Fidelity brokerage account. This is not in my retirement account at all. I wasn't taking any risks in my retirement account. I still had that equity income fund, but I bought this Select Electronics fund in 2000. I turned $5,000, or about five, if I remember correctly, it was about $5,000 or $6,000 into $2,500 in less than a year. So I magically made a 50% negative. It was great. I sold, and the only consolation was that if I had held that money in there, it would have taken nearly 20 years to get back to where it was. That bubble was so big. And I had bought in near the peak of it. I think it had dropped back down just a little bit before I had purchased it. So it was already starting its decline. I bought back into it, or I bought into it, and turned my 5 or 6K into 2.5K. I learned not to chase investments with this one and to look at the valuations of things, because the valuation should have told me that it was not worth it at all. I don't even know that there may not have even been a PDE ratio on most of the investments in that mutual fund, meaning they weren't making earnings. A lot of these companies were losing money, or if they were making money, the stock price was so high that the PDE was a very large number. That, I'm not talking about, 50, which is large, very large. They were probably in the hundreds or thousands for the PDE ratios on these things. And I didn't really know anything about that and didn't realize. I just thought this thing's going to keep going up, and I didn't want to miss out. It wasn't the only time that I lost money, but I did risk smaller amounts later on. I messed around with options a little bit, but this was a very small amount of my portfolio as my career went on, or not career, but my investing path went on. I only risked a very small percentage on these types of things. And now I still do a little bit, but it's never more than 5% of my total investments. And I still don't mess with my retirement account at all. Something I also learned from Personal Finance for Dummies was not to insure the small stuff. If something could financially ruin me, then I insure it. I have health insurance. I have homeowners insurance. I do have a term life policy, which will lapse in the next couple of years since we don't need it anymore. And clearly I have auto insurance, which does not include comprehensive or collision. In the many years that I've not carried full coverage, so meaning that I don't have comprehensive or collision, I've still never had a comprehensive or collision claim. There have been a couple accidents, but they've all been somebody else's fault, so their insurance pays for it. If it's my own fault, then I'm willing to fix my own vehicle, basically. And yes, there is the chance that like a tree limb falls on my car and I have to pay for that myself. But I've saved enough over the probably 15 years that I haven't had full coverage that it more than makes up for maybe having to repair something like that. And I don't really care if something necessarily, if it's cosmetic, I don't care if it gets repaired or not. I had a deer hit my car a couple years ago. Actually, it was last year. Dented up the front right or front left fender, and it's not a safety issue at all. It doesn't look great, but it doesn't affect the functionality of the car. So I'm not paying to fix it. And I'm not going to, try to get well, obviously I can't claim it on insurance because I don't have coverage for that. Additionally, I always decline coverage for electronics. You know how to the department store or whatever, you'll purchase anything electronic, and they'll offer a 2-year plan or something like that. And it might be a significant amount. It might be, you might buy a $200 item and they're going to charge you $14 for a 2-year replacement plan. I never pay for that stuff. It doesn't provide me peace of mind because over the years, I may have had 1 or 2 things break that I had purchased, like electronic items or anything that would be covered by something like that. And I ended up getting them replaced anyway for free. Just contact the company, whatever, or even when I was stationed in Italy, I actually ran something through the washing machine. I had a little PDA, and it went through the washing machine. I called about buying a replacement, and they gave me one for free. So I'm not sure. I didn't have coverage for it. I had purchased it, I don't even know, like a year and a half or 2 years prior to that. And they just went ahead and replaced it. So don't insure the small stuff was something that worked for me. If it provides peace of mind for you, then I guess continue to do it. I personally think it would have been a waste of money for me. The final thing I want to talk about is the fact that I'm pretty boring. If you've been watching my videos, you probably realize that. I am not extravagant in any way. I do a few things. I like to run, which obviously that's shoes and some clothes here and there and a GPS watch. That's what I probably spend most of my money on each year, because I need a couple pairs of shoes per year and a watch probably every 4 or 5 years. But I'm pretty boring. And my wife is not boring, but she also grew up not having much. So for both of us, what we have now seems to be a lot. So even though we're not spending a ton of money, we feel like we're spending a lot. It made things a lot easier with when I mentioned the monthly cash flow. Our budget is mostly covered by my pension. Obviously, that would be huge for anyone if you don't have any debt payments and you eat at home most of the time. We don't always eat at home. We do eat out some, but we don't have expensive tastes. We don't drink. That a lot of times I see that at a restaurant, the drink bill is half the bill. Depends on the restaurant, I guess, but we don't have a lot of experience with that. But looking at the drink prices, if you have 2 or 3 drinks with your meal, you're probably paying more for the drinks than you are for the meal. Maybe people have more experience with that than I do, but that's what it seems like to me. Our restaurant bills are pretty low. But overall, we stay at home a lot. We do a lot of walking, hiking, stuff that's free. When I say hiking, I mean basically walking on easy trails. We did buy kayaks. We've been out on the kayaks a few times. We don't do a lot, and what we do isn't that expensive. In conclusion, there's no guarantee for success, and success is subjective. Again, if your expenses are low, then it doesn't take as much. But if I was somebody else, I wouldn't think that this is success. There are tons of people out there that there's no way they would consider the amount we're living on per month as successful. But for us, it's been great. We are happy living frugal lives. But they're not frugal compared to what we have known our entire lives. So we feel pretty good about it. If you have any questions or comments, leave those below. And remember, if you're going to retire, retire to something.